All right, something just happened in the silver market that almost nobody is explaining correctly in real time. We just watched silver in Western markets collapse from roughly $121 an ounce down to about 84. That's a 40% wipeout. Fast, violent, and ugly. And while Western investors were panic selling, new reports hit that China stepped in and started buying billions in gold and silver almost immediately. Here's the kicker. Shanghai silver never crashed. It's still trading near $122. Same metal, two prices, a 40+% gap. That doesn't happen unless something structural just broke. Stay with me because I'm going to show you exactly what that tells you and how to spot this setup before the crowd next time. Before I explain what caused this, let me slow you down and teach you something most people never learn about commodity markets. When you see a price collapse like this, your instinct is to assume demand disappeared. That's the story you're fed. Markets crashed, people don't want it anymore. The bull run is over. But price doesn't always equal reality, especially in metals. And this is critical to understand. There are two silver markets running in parallel. There's the paper market, which is futures contracts, options, derivatives, all these financial claims on silver that trade electronically. And then there's the physical market, where actual bars of metal change hands. Now, most of the time, these two markets stay roughly in sync. But when stress hits the system, they can decouple violently. Think of the paper market like a crowded elevator full of leveraged traders. Everything's fine until the cable snaps. When that happens, people don't exit calmly. They smash buttons. They dump whatever they can, at any price, just to get out alive. That's not supply and demand changing, that's forced behavior, panic liquidation. And if you don't learn to separate real demand from paper stress, you'll keep misreading moments like this. You'll think the bottom fell out when really it's just the leverage getting flushed. So, what does that tell us? It tells us that when you see violent price action in commodities, your first question shouldn't be what changed fundamentally. Your first question should be, who's being forced to sell and why? Now here's what's actually happening, step by step. Silver had been pushed higher largely through leverage paper positioning, futures, options, structured products, all stacked on top of each other. Traders weren't just buying silver, they were buying silver with borrowed money, multiplying their exposure. And that works great on the way up. Every dollar silver rises, you make 3, 4, 5 times that on your leverage position. But leverage cuts both ways, and when volatility spiked recently, everything changed. Brokers looked at the risk and said, we need more collateral, margins went up, risk limits tightened across the board, and suddenly, traders who didn't want to sell, who actually believed in the silver trade, had to sell anyway. Not because their thesis changed, because they ran out of margin, they got the call. And when you get the call, you don't get to choose your exit price. You take what the market gives you. That's the primary driver here. Forced deleveraging across the paper, silver complex. Now, here's the secondary confirmation, and this is where it gets really interesting. The price split itself. If silver were genuinely oversupplied, if real demand had evaporated, Shanghai would have collapsed too. Physical buyers around the world would have backed away. But that's not what happened. Shanghai stayed firm. Chinese exchanges, where physical delivery actually matters, held near $122. Physical buyers didn't disappear. They didn't panic. They waited. And here's where it gets wild. That 40% premium, that massive gap between paper and physical, tells you everything. Physical demand never blinked. The metal didn't change. The fundamentals of silver as an industrial metal, as a monetary metal, none of that changed overnight. Only the paper claims on it did. Only the leverage bets got shaken out. So, when margin calls hit Western desks, paper silver floods the market. Sell orders stack up. Prices gap down. And at the exact same time, on the other side of the world, China steps in and converts that paper weakness into real metal at a discount. That convergence matters. One side is being forced to liquidate. The other side is choosing to accumulate. And if that sounds familiar, it should. But here's the part that should make you nervous if you're ignoring it. This isn't random, this is repeat behavior. This is a pattern that shows up over and over again in commodity markets. And if you don't recognize it, you're going to keep getting caught on the wrong side. Zoom out for a second. Go back to 2008. During the financial crisis, precious metals got absolutely smashed as hedge funds and institutions liquidated anything liquid. Silver dropped from over $20 down to below $9 in a matter of months. Gold fell hard. People thought the metals trade was dead. But what happened behind the scenes? China accumulated aggressively near the lows. They didn't announce it. They didn't make press releases. They just quietly bought physical metal, while Western investors were dumping paper contracts in a panic. What happened next? Silver bottomed in late 2008, then went from $9 to nearly $50 by 2011. Same pattern we're seeing today. Fast forward to 2020. Remember the initial COVID panic? Silver collapsed from $18 down to $12 in about 2 weeks. Markets froze. Volatility went through the roof. Margin calls everywhere. And once again, forced selling exhausted itself. Physical buyers stepped in, and silver rebounded violently. It went from $12 to nearly $30 in less than a year. Every time you see this combination, violent paper sell-off, stable physical pricing, and sovereign buyers or strong hands stepping in, you get sharp rebounds. Not gentle ones, not slow grinds higher. Volatility stays high, sure, the swings continue, but the direction changes fast once the weak hands are gone. Once the forced sellers have nothing left to sell, that's when real price discovery begins again. And right now, we're potentially in that zone, that transition period where the leverage is being flushed, but the physical demand is holding firm. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could silver go lower from here? Absolutely. Forced selling doesn't always stop cleanly. There could be another wave of margin calls. There could be more funds that need to liquidate. $84 might not be the bottom. We could see 70, we could see 60. I don't know. And anyone who tells you they know exactly where the bottom is lying to you. Could this premium narrow because Western prices bounce instead of Shanghai falling? Yes. That's actually the bullish scenario. If New York silver rallies back toward 100 while Shanghai holds steady, that gap closes from below, which confirms the crash was technical, not fundamental. And no, you don't need to believe in some grand manipulation story to understand this. I see a lot of people jumping to conspiracy theories, saying the banks are suppressing silver, saying this is all rigged. Maybe, maybe not. Here's the thing. It doesn't actually matter whether there's some coordinated effort or not. Markets don't need villains. They just need leverage and stress. When you have too much leverage in a system and volatility spikes, you get forced selling. That's just math. That's just how margin works. The key isn't predicting the exact low. The key is recognizing when price action is mechanical instead of fundamental, and adjusting your expectations accordingly. If this sell-off is driven by forced liquidation rather than collapsing demand, then the recovery can be just as violent as the decline. But you have to stay objective. There are probably 3 types of people watching this right now. Let me speak to each of you directly. The first group is already long silver. You bought in at 90, at 100, maybe even at 115. And right now, you feel punched in the gut. You're watching your position bleed. You're wondering if you made a terrible mistake. You're thinking about cutting your losses and walking away. If that's you, let me say this clearly. I get it. This hurts. Watching a 40% drawdown is brutal, especially if you size the position too large. But panic decisions made during forced selling environments are usually the worst ones. This is exactly when retail capitulates and institutions accumulate. Your job right now isn't to feel good. It's to stay objective and watch structure. Ask yourself, did the fundamentals change? Is silver suddenly not used in solar panels anymore? Did industrial demand collapse overnight? Or did paper traders just get margin called? If it's the latter, and you still believe in the thesis, this might be the time to hold, not fold. But only you can make that call based on your risk tolerance and position size. The second group has been waiting on the sidelines. You've been watching silver rally, saying you'll buy when it feels safe, when the volatility calms down, when you get a pullback. Well, here's your pullback. Here's the volatility. And now, it doesn't feel safe at all, does it? It feels chaotic. It feels like catching a falling knife. And that's exactly the point. It never feels safe near real inflection points. By the time it feels safe, the easy money has already been made. The best entries come when your stomach is churning, when the headlines are screaming crash, when everyone else is running for the exits. That doesn't mean you jump in blindly. That doesn't mean you go all in at 84. But it does mean you start paying very close attention. You watch for signs the forced selling is exhausting. You look for stabilization. You build a plan instead of waiting for perfect clarity that never comes. And the third group thinks this is all noise and wants nothing to do with it. You're not interested in silver. You don't care about commodities. You think this whole thing is just speculation and gambling. That's fair. I respect that. But even if you never touch silver, you should still learn this pattern because it shows up everywhere. Stocks, crypto, bonds, real estate. Anywhere leverage builds up in a system, you get these forced liquidation events. And if you can recognize them, if you can separate mechanical selling from fundamental deterioration, you'll make better decisions across every market you trade. This isn't just about silver. This is about understanding how markets actually work when stress hits. Here's the universal principle you should walk away with, regardless of which group you're in. When prices crash but physical demand holds, and strong hands step in quietly while weak hands are forced out, you're watching a transfer, not a collapse. Wealth moving from weak hands to strong hands, from leveraged speculators to patient accumulators, from paper claims to real assets. That transfer is painful if you're on the wrong side, but it's opportunity if you recognize it. So here's where I stand personally. I'm not chasing this. I'm not panic buying at 84, thinking I'm catching the exact bottom. But I'm also not panicking. I'm not convinced this is the end of the silver trade. I'm watching. And let me tell you what I'm personally watching. First, I'm watching whether 80 to 85 holds in Western markets. If we see silver stabilize in that range, bounce a bit, fail to make new lows even on another wave of selling pressure, that tells you forced selling is exhausting. The sellers are running out of inventory to dump. Second, I'm watching Shanghai stay above 115. As long as physical markets hold firm, as long as that premium stays elevated, it confirms that real demand hasn't collapsed. It's just paper getting flushed. Third, I'm watching that premium itself. Right now we're looking at a 35 to 40% gap between New York and Shanghai. If that premium stays above 25% through next week, if it doesn't collapse quickly, the near-term recovery case stays alive. It means physical buyers are still willing to pay up. It means the divergence is real and structural, not just a temporary glitch. Based on my analysis, this crash was mechanical, not emotional. It was structural, not fundamental. The metal didn't break, the leverage did. The fundamentals of silver, the supply deficit, the industrial demand, the monetary demand, none of that evaporated overnight. What broke was the over-leveraged paper positioning. And when leverage breaks, you get violent moves, you get gaps, you get pain. But you also get opportunity if you're positioned correctly and thinking clearly. If history rhymes even a little, if this follows the pattern we saw in 2008 and 2020, the next move won't reward the loudest voices. It won't reward the people screaming that silver's going to 1,000 or the people screaming that it's going to 0. It'll reward the patient ones, the people who can stay calm, watch the data, and make decisions based on structure rather than emotion. Now, I'm not a financial advisor. This is not financial advice. I'm sharing my perspective, my analysis, what I'm watching. You need to do your own research. You need to make your own decisions based on your own risk tolerance, your own financial situation, your own investment goals. Don't take anything I say as a recommendation to buy or sell anything. This is education. This is pattern recognition. This is me showing you how to think about these situations, not telling you what to do. If you made it this far, you're clearly someone who thinks for themselves. You're not just looking for hot tips or quick profits. You're trying to understand how markets actually work. That mentality will serve you well, not just in silver, not just in commodities, but across everything you do in investing and trading. The people who win long-term aren't the ones who get lucky on one trade. They're the ones who develop frameworks, who recognize patterns, who stay disciplined when everyone else is losing their minds. So here's what I want you to do. If this analysis helped you see something you weren't seeing before, if it gave you a framework for thinking about this differently, do me a favor. Share this with someone who needs to see it. Subscribe if you want more of this kind of analysis. And drop a comment telling me what you're watching right now. Are you in silver? Are you waiting? Are you staying away completely? I want to hear your perspective because that's how we all get better at this. Stay sharp out there. Think critically. Verify everything. And make your own decisions. I'll see you in the next one.